on today's show, how engaging clients on effective marginal tax brackets can open up opportunities. Part 2 of this week's series on tax advantage strategies with nationally recognized columnist Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmark. Let's get down to business. Ken, welcome to day 2.
Hey Steve, good to see you.
We're going to be talking about IRAs. We're going to be talking about Roth IRAs. We're going to be talking about more magi. I can't get rid of this term, right? And once you understand how to use this effectively, this can be huge. Now, I just want to give a heads up because we're going to be talking about Roth conversions. One of the biggest things I like to do is make sure that I don't, if I'm going to convert my Roth, I want to stay within the bracket that I'm already in, my top marginal bracket. I really don't want to bump myself into another bracket if I can. Many people, it's all or nothing. They just convert the whole Roth, pay this huge chunk. And I'm thinking sometimes you can amortize or make smaller payments. So you can go ahead, what I call bracket bump, trying to stay away from bracket bumping to the next level. But if I got headroom or I got some space in my bracket, I want to utilize this.
Mm-hmm. Yeah, basically what we're talking about is in a retirement mode, assume that we have somebody where a substantial amount of their money is coming out of their IRA. So they're taking distributions. There's no 10% penalty anymore. They're now having taxable income come out, though. Mm-hmm. And, of course, that's included in gross income. If we remember our tax return, it's included in gross income, flows to adjusted gross income, then is modified, and that determines all kinds of things like, is your Social Security being taxable or not?
When we talk about Magi now, one of the big things that we're always having debate, we hear people say, well, you know, Steve, I've done the Magi. I've had somebody do it for me. I'm looking at these contribution limits. And I notice now, and of course, we're taking this right off Backroom Technician, which you can go out and get a 30-day free trial on. We've been using it since, I think I've been using it since 1992. It's a huge, wonderful reports. I love this report because it kind of breaks down some of the issues here and how Magi now affects deductible IRA contributions, which we never had to deal with before.
Well, it's been around a long time. It's just that it's become more pervasive. And it's basically the government wants us to believe we have certain deductions and exemptions and credits, and up to a point we do. But this whole theme or theory of going after the quote-unquote rich, they define rich by what is modified adjusted gross income. What's interesting is MAGI for Social Security is different than MAGI for Medicare premiums or for other types of deductions and exemptions. So being rich is all over the board. They can't even make up their mind on it.
Before you go any farther, I just want to know just the issue of what is rich. Magi, MAGI is clicking in. Look at this, up to 60 grand. Some of this is married filing jointly up to 116. This does not sound like the affluent to me. This sounds like middle America.
Well, this is not the $250,000 we were sold politically in the last presidential campaign. Now, this is for where one or both of the spouses is married, that they're married to, is covered by a plan. So there's all kinds of rules, and MAGI just kind of creeps in. The point I want people to understand is that tax rates by themselves are just a beginning point. We have to see what other effects on the taxes in terms of including income into it, reducing deductions and credits or exemptions. What does that ultimately do to the end marginal effective tax rate? A lot of people talk about marginal tax brackets and, gee, if I add this income, my marginal increase is this. That's true. And effective rate is basically, here's my total tax divided by my total taxable income. That's my effective rate. We've kind of coined a new phrase because we're saying we have a marginal income tax bracket, but then it's affected by all these other calculations. So we're using the term effective marginal tax bracket.
Well, because of this, now we're talking about, I could have retitled this section about calling it, should I deduct my IRA or should I do a non-deductible Roth? Because once I've done this basic understanding or done a process to see, hey, is it really worth taking the deduction? Because if we're doing a lot of Roth conversions, there's no doubt about that. And I'm starting to wonder, I wonder if I should have taken the deduction to begin with. Most of middle America is not in the high tax bracket. Their deductions in the blended progressive marginal bracket may only be 15 to 20%.
You brought up a really important point. As advisors, it feels good to get a deduction today, but in the long term, having a Roth or no taxation on the end is really more valuable. For instance, when you do a traditional comparison of Roth versus regular, if the tax bracket is exactly the same at the beginning and the end, it's pretty much a wash. You have to go through a bunch of calculations to get there, but trust me, when it's all said and done, it's pretty much the same thing of after-tax income to live on. the assumption is if tax brackets go up, then a Roth is a better idea because you don't want to get your tax deduction at a low rate and then be taxed at a higher rate. Well, when you start factoring these effective tax rates, when you throw in the taxation of Social Security income, the increase in Medicare premiums, now actually the reduction in credits against your Obamacare Medicare, I mean, it's hitting low income, medium income, high income people. It's pervasive throughout the code and even non-code like Medicare premiums. You just have to remember the impact. So effective marginal tax bracket is taking, if I have this additional income, what's the tax bracket that's going to be applied, but then looking at all the effects that this additional income has on inclusion of Social Security income, Medicare premiums, and other types of things. So the only real way to do this is to either buy a good software package that you do your tax returns on and play with it yourself. You know, do what-if scenarios. If I do this transaction, create this income, is it really 15% of that 10,000 or 1,500 in cap gain, or is it something more?
It's something more. Most
And
of the time,
when you run it through your tax calculator software, that'll tell you.
When we come back from here, we're going to talk about this, and this is why once you learn some of the things that we're talking about, your tax advantage products that we're talking about, annuities. We're talking about annuities with LTC linked benefits. We're talking about life insurance. At the end of the week, we're going to be talking about all this. When we come back from the break, we're going to talk more about this because once you learn this, it can help you sell some of the things that we sell, which are tax advantage products. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Welcome back to segment 2. Ken, well, this is a little history. I like this from Backroom Technician. Again, you can order your own absolutely free. And for the next 30 days, I should say free, their demo's free, 30-day free trial. IRA historical limits. Now, what I like about this is you kind of see what's happening over about a 5-year period. This is a really great, I love digest, a summary statement on how qualified plans, the IRAs, and how they work, including, by the way, the catch-up provisions. But let's go right into Roths here, Ken. I'm always told, once I get past the to Roth or not to Roth, am I going to take the deductible IRA or the Roth IRA? Now, when I decide I'm going to do Roth IRA, I have a second decision. Should I do Roth or should I do a TAMRA-compliant minimum death benefit life insurance contract? Because I'm looking at two different ideas here that have some similarity except for the death benefit on a Roth. I can't put life insurance into a Roth. So I'm wondering, should I actually look at life insurance versus a Roth? And from a CPA point of view, give me the yin and the yang.
Well, there's a number of things to consider, and there's no one answer to the question. However, if you look at contributions, the upfront part of it, you're limited on the contribution to typically $5,500. However,
on the Roth.
On the Roth. On life insurance, you're really limited based on your insurability and how much insurance you can buy and how much you can stuff cash into it. Now, of course, you can have increasing death benefits and option B and that kind of thing. So you can stuff a whole lot of cash in it. Secondly, a life insurance policy doesn't have a 10% penalty before 59.5.
So I'd have that with the Roth.
You'd have that with the Roth has the penalty, whereas the life insurance doesn't. And in terms of ages, I mean, think about a 25-year-old person who's smart enough to be putting money away, even small amounts, a couple $100 a month, towards their retirement, and what a huge time value of money benefit that is. The life insurance gives them access to that cash, whereas he's stuck with a 10% penalty, he or she, before 59.5. So the liquidity feature is really exceptional. You may get into some legal things about whether the assets are protected against creditors, and that may be important for a doctor or other people in a high vulnerability situation. And certainly qualified plans and IRAs based on federal law has some protection. Your particular state's going to determine whether or not the cash value of your life insurance is protected or not. So there's a lot of different things, but I really like the liquidity. I particularly like life insurance for younger people instead of IRAs with 59.5.
I was looking, I did some blogging during the President's Day about 6-7 weeks ago, and we were comparing Washington's to Woodrow Wilson's 100,000. Washington's a dollar bill, Woodrow Wilson's a $100,000 bill, and taking a basic 25-year-old who was putting $100 away, getting maybe only 3.5 to 3.5%. So that $100 was equaling 100,000 just because of the time of just consistent putting money aside and accumulating tax-free.
Let's talk about one more thing, and that is the forced distribution at 70.5. You know, regular IRA has forced distribution. Both the Roth and the life insurance don't, so they're equal on that point, which is really nice. And now let's talk about death, because
let me make sure I understand. So on the Roth, we really don't have a 70.5.
That's right.
Okay, because I noticed we have the 59.5 and 10% as you cited, but there's not the back door. There's not the end game.
Well, even more so, if somebody gets past 70.5, they might want to make a contribution to an IRA, then the Roth is available, whereas the regular IRA is not.
You can't make any contributions.
That's my understanding, yes.
Yeah.
So, and then of course at death, I mean, as planners, we talk about accumulation, distribution at retirement, now distribution at death. Well, the Roth is cool because you can extend the deferral for the children on a stretch IRA concept. But the life insurance is, here's your cash. It's all tax-free. Just take it. They can either spend it, invest in an investment in a new business, or invest in their own life policy and start all over again at lower cost of insurance.
And just a heads up, just because Ken and I are going to talk about this Friday, just give you a whet your appetite for Friday show. You know, you could annuitize that life insurance contract. Now you'd be giving up withdrawals, tax-free withdrawals, and tax-free policy loans of gain. But if you were looking at maybe joint, beneficiaries on that, and there's a lot of games to be played, and depending upon your tax bracket, we just want to give you a heads up on that, and we're going to talk about this by Friday.
Okay, so we're going to go into that more detail on Friday.
Much more Friday.
Yeah, we did an analysis years ago for a bank-owned life insurance, and it was kind of surprising for both of us, I think, when we looked at the after-tax cash flow of the normal tax-free withdrawals or loans versus the amortization of basis over life expectancy. It wasn't that big a difference, and boy, the management of just annuitization is a whole lot easier to deal with.
Well, that's true. And then think about this. We're trying to compare always deductible IRA or non-deductible Roth. Look at that. Then when we choose the Roth, I want to look at Roth IRA or am I going to use life insurance?
And the key here is to do the planning up front. Once you've already accumulated it in an IRA or something else, then trying to convert it becomes expensive. But if you did it in the first place, you know, you're not only planning for now, but you're planning for the future. And just remember that the inclusion of Social Security, Medicare premiums, other types of things actually makes the marginal effective tax rate higher. So when you do your traditional analysis of Roth versus a regular, take into consideration that the tax rate, effective tax rate, marginal income tax bracket is actually higher than what the tax brackets say.
Ken, one little side point, and this is right off background technician, then we got to go. I love this thing where it says this one-time direct transfer from an IRA into an HSA. I just saw a client do this.
Did you?
Yeah, and I was amazed because now that's done now. He's already done it one time. But he could move his money to an HSA account. Somehow the government's seeing that we're going to need this in our medical plans. And I'm thinking, if you had an IRA, you could push this to your HSA account, and then when it came out for medical, right, it would be free.
Well, that's, yeah, and kind of the holy grail of our industry is what? Tax deductible up front, tax-free on the tail end. Well, if you had a tax deductible IRA and you roll it into an HSA and then the distributions are for qualified medical expenses that aren't taxable, you've essentially gotten tax-free at the end, haven't you?
You have. Listen, there's games to be played. Once you understand the rules of engagement, they can be powerful for the client and actually create more cash flow because of the tax issues. Well, that's all we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. Ken and I will see you.